morning. It's working now.
There you are.
It's an honor for me to be part of this seminar today, and I'm very happy to see some familiar faces here, including my husband in the back. For those of you who don't know me, my name is Vanessa Fiusa. I'm a partner at Mattos, Filho corporate group based in São Paulo. The firm has one of the largest and most active securities practice in Brazil, and in one way or another we have been involved in most IPOs in Brazil. One of our founding partners, most of you know, is Osvaldo Mattos Filho. He is a former chairman of the Brazilian Securities and Exchange Commission, so the practice has been at the heart of our firm since its inception. Following the impeachment of the former president, Mr. Dilma Rousseff, the IPO's activities in Brazil are at the highest levels. The number of IPOs and follow-on offers continues to rise, keeping all the investment bankers, lawyers, sponsors, regulators very busy. 2017, we surpassed last year's with 21 public offerings in Brazil. As a reference, we had in 2014 only 2 public offerings. So some very economic key players in Brazil, as the French retailer Carrefour, the Brazilian airline Azul, founded by Mr. David Neumann, and Biotoscana, a Latin America pharmaceutical company, were able to completely successful their IPOs. Even Burger King, that's a master franchisee in Brazil, partially owned by 3G and Warren Buffett, is expected to price its IPO in December. So against this backdrop, we are fortunate to have here experts on this panel that have experience from all sides the Brazilian securities market evolution. So let me briefly introduce you to our panel. We have Francesca. Francesca is a partner, very experienced partner from Cleary Gottlieb. She has focused on financing transactions in Latin America. She has also advised on debt and equity transactions a lot of Brazilian companies, and we had the pleasure of working together in many deals. Cleary remains one of the top law firms in the US that advises the largest Brazilian companies. We also have Robert. Robert is the Vice President of Nasdaq's Listing Services Unit at the Global Head of Capital Markets. He provides leadership and strategic directions to Latin America listing efforts. He also has previous experience with the New York Stock Exchange, so he has witnessed firsthand the evolution of capital markets and been through many cyclical changes. Thomas is Managing Director and co-founder of Jaguar Growth Partners. As you all probably know, Jaguar is a privately held investment management firm specializing in real estate, private equity, in growth markets globally. They have many years of experience investing in Latin America, and Thomas is personally involved in many real estate Brazilian companies. So let's start, Francesca. Francesca, I had a lunch last week with the CEO of one of these companies that had its IPO in Brazil within the last 12 months. And he was telling us that despite all of his expertise dealing with strategic and complex deals, the IPO was the most challenging transaction of his life. He was telling us as well that I thought was really impressive that on his IPO almost 300 people were involved. Thousands of pages were produced, and for all that, he wanted to write a book about it. It's really true. So we all know here that IPOs are a regulated and very challenging process. So could you give us an overview on the challenges and that you have faced working with the IPOs in Brazil?
Sure. So there are a lot of challenges in executing an IPO in Brazil right now. Those challenges have only grown over time, I think. So we thought we'd focus on maybe two to start with, and then we can talk about others if people have questions. I guess the first one I'd touch on is the entire kind of marketing of an IPO. That's really different in Brazil than it is in the US if you were doing a public deal. And if you think of Vanessa's story, not only does he, I'm sure, want to write a book now, but lots of people want to write the book while they're doing the IPO, in the sense that they want to be out there talking to people from day one. And that's something that's really hard to reconcile with all of the securities laws in the different jurisdictions where you might be doing an IPO. It's super hard if you're trying to do a registered IPO here in the US as well as one in Brazil, because we have a lot of rules about what you can and can't say before you go public. In Brazil, I think, is one of the areas, at least, or the jurisdictions, where we've had very early development of lots of pre-marketing activities, probably more so than in any jurisdiction globally, other than maybe a couple Asian jurisdictions. It kind of all starts when banks get hired and they want to, and the company wants to do kind of a non-deal roadshow. By definition, once you hire a bank, you're sort of in deal mode, so those two things don't always fit really well together. And so, what they want to do is start talking to a potential investor base, right? Because they're excited. They want to know if people are excited in a potential deal. So managing that process very early on in the deal and managing communications is something that's really hard. What has evolved in the Brazilian markets is that analysts have started playing a really big role in that. Again, this is specific to Brazil because in the US, because of the research settlement, some other rules, there are a lot more rules on what analysts can and can't do. But on Brazilian deals, at least, what we've seen evolve is investor education, where analysts take information that is either publicly available or provided by the company, and they start educating investors about the company. Real big challenge in that is that you have not written a disclosure document yet, so you don't know what's going to be in that document. But at the same time, you're talking to people and you only want to be giving them information that is ultimately going to be in that prospectus, because you can't be providing people with selective disclosure in any country. So that has made it really difficult to kind of get through that first stage of an IPO, because there are a bunch of rules bumping around. Every bank has different rules internally. You're reconciling a bunch of different jurisdictions. That means that from a company perspective, there's a lot of regulatory moving around, a lot of rules, a lot of adapting rules, and things like that. And that kind of continues throughout the process, right? Even when we get closer to potentially pricing a deal, then they move into pilot fishing mode, which is what folks call, the exercise of trying to figure out, to gauge interest, and decide how to price a deal. So I would say that chunk, at least from kind of the different players from an execution perspective, you see a whole lot of noise surrounding that part of the process, and it's pretty hard to manage. The other thing I think I'd mention is, which you touched on and the prior panel touched on, is just the diligence process. A lot of people like to think that diligence is a lawyer thing and that lawyers have to do diligence in order to give a legal opinion, and that's its importance in a transaction. But that's actually not its importance. It's really a way to manage liability for all the different players in an IPO, because the defense of having done due diligence can be incredibly important for an underwriter or other participants. And so that diligence process has changed a lot since 2014. I think that not only banks who are involved in underwriting a transaction, but investors want to understand a lot about the company. They want to understand the history, what types of transactions the company has with the government, what types of contracts they may have that are sensitive and could involve some issue of fraud or bribery. There's a specific focus on compliance with all the anti-money laundering laws that are applicable in the different jurisdictions, including in Brazil. And so that diligence phase lasts a lot longer than it did when we were during the IPO boom of 2005 through 2008, right? It's much more involved. People want physical site visits. They want to talk one-on-one with management. The diligence process in some ways is more like it is in a US registered IPO, where you may call major customers, major suppliers. That's something that you really did not see in the Brazilian market pre-Lava Jato. And so I think that's the other thing, that especially for managing it from either whether you're a deal professional or whether you're a company, it takes up a lot more time, and it's a super important part of marketing, because when you're going out and trying to sell that deal, people want to understand the risk that, phase, I don't even know what phase we're up to, but phase whatever of Lava Jato is not somehow going to involve this company or a sponsor in the company.
Good. We know that the CVM and the SEC process are different when reviewing. Their review process are really different. And how do you manage to do this in dual listing process?
So the SEC and the CVM have gotten better at working together, and so there are some aspects of the process that's easier now than it used to be. And they talk a lot because of Lava Jato anyway, so they're good friends. In an SEC process, it's lots longer. It takes although the initial review process is like 4 weeks, just like it is with the CVM, there's a lot of subsequent review that goes on that means that the front part of your deal is a lot longer. Why is that important for all of you? Because these windows close and open a lot. And so if you're sitting at a regulator for 8 to 12 weeks, that window can close. In Brazil, you have a much higher chance of getting through the regulator in, let's say, 6 to 8 on a true IPO. And so, that really is a kind of difference in terms of timing, I think. In terms of the substance of the review, the SEC review is incredibly rigorous. You have review by the capital markets group, you have review by the accounting group, and then you have the industry-specific group. So if you're doing a mining deal, like we priced last week, you could get tons of comments from the engineers, and they want detailed answers, and they want to be able to talk through that. So you aren't getting usually that specific of industry-type comments from the CVM. I think also the CVM is more comfortable with an issuer going out in the market faster, potentially still towards the end of the review process. Here, it's highly risky to do that, and so you'd want to make sure you kind of officially cleared it with the SEC. I think one really interesting trend in the Brazilian market is how follow-on offerings are dealt with. The CVM has now published a rule, it's called 476, and transactions are actually usually called 476 transactions if you're doing them under this rule, that it basically allows you to go out to a certain type of investor, almost like a QIB here in the US. Mm-hmm. And that's an accelerated deal, and it actually has no review, just like a 144A deal would have here in the US. That's allowed deals to move really, really fast. It also means because you're not waiting for the Brazilian regulator, the US piece of the deal has to move equally fast. So oftentimes you're doing all these meetings with all these investors, and you're also simultaneously drafting, disclosure documents in both languages. Mm-hmm. So I think it's a much faster type of deal. It does allow you to get in before windows close. From an execution perspective, it's trickier, I think. Yeah. But it does allow more flexibility in the market.
And despite the speed of these deals, I agree with you, it's much faster. Have you faced other challenges? As, of course, we know that banks really want to talk to investors before. We don't have filing here, but they would do after filing in a registered deal. So how do you allow the bankers to go to the market and test the waters in a non-registered deal that we don't have a public filing?
Yeah, so it's hard. It's very hard. I think usually we like for banks or for investors to know that there's a possibility of a deal happening, because you don't want to be providing, especially if it's a follow-on deal, right? If there's an existing market, you can't be running around giving non-public information to some people and not others. That would be really bad in any market. And so what we usually do in that context is notify the market that there might be a deal. And so then everyone knows, level playing field. And then when you're running around and talking to people, you have to make sure that you're limiting it to information that's already out there in the market. Otherwise, someone could trade on it. That is tough to do for a lot of institutions. I think it's hard. It's a very fine line between marketing and providing information that's already out there. So it's hard. In the US, we limit that. Even on a 144A deal, we limit that pretty strictly. We would only, because it'll be an unregistered deal here in the US, we would only ever allow people to talk to QIBs, so large institutional buyers. And in particular, because of the different activities that might be going on within an underwriter, right? They might cover the company doing research. They might have a lot of other interactions. We're pretty limited in doing that. And so we usually encourage people to go to a fixed number of big investors, which is usually fine for these types of deals because you're not selling them to individual folks, you're selling them to Fidelity, to big, kind of institutional buyers.
Robert, for your extensive and very impressive resume, I believe you are the right person to give us a view on the regulatory framework for dual listing and also US listing as well, and the role of the stock exchange in today's market.
Thank you. I think what's happened, interestingly enough, over the past few years is that there's been a kind of a sea change in the way that the deals have come. When I first joined Nasdaq 11 years ago, a lot of the deals would come through 144A in the US with registration rights, and then 12 months later, there would be an offering of shares in the US. And that was a big part of, as Francesca was saying, this boom between 2005, 2008, and some lingering on even in the crisis. And then the deal flow slowed down. As we talked about earlier, the deals have literally just picked up in 2017, where there had been kind of a barren desert for 3 or 4 years in Brazil of IPOs. And now it feels like they're falling into 2 categories. One is common shares directly listed in the U.S. or dual listing of shares between B3 and the U.S. market, simultaneously. And so I think Francesca went through the kind of nuances between the regulatory environments. For us, it's really about us talking about the benefits of listing in the U.S., the benefits of listing on Nasdaq versus just staying in the local markets. And I will put out my disclaimer that I put out to everyone, which is we never go into jurisdiction and try to convince a company not to list in their local market. In fact, we believe that most companies belong in their local market. We don't believe that companies should come and list in the United States just because we have the greatest capital markets in the world. We do. But the reality is that most companies belong in their local markets. People aren't going to understand a consumer products company that only sells in Brazil or a supermarket chain that only sells in Hubei province, China, or education company that is doing bricks and mortar education in Indonesia is not a U.S. listing type of company. But there are going to be a number of companies, I won't put a percentage on it, but a small number of companies in every jurisdiction that will want to grow a global brand, a regional brand, one that extends well beyond the borders of their country. And in that case, they will want a listing outside of their country or a dual listing, including the local listing. And those are the companies that we talk to and that we talk about the benefits of a Nasdaq listing and why they should consider being listed in the US, why they should consider being listed on Nasdaq, and the way that we really engage with them to help them in the transition from private to public, and then supporting them every day as a public company. Because the thing that we've really focused on is an understanding that once a company has chosen to list outside of their local markets, that, as we've all agreed, it's not easy. And it's not that the earlier part that the bankers and lawyers and others are involved in is not easy. Every day as a public company is not easy. And that's if you're, Starbucks or Google or American Airlines, or if you are a brand new $250 or $500 million market cap company, you have an endless series of quarters ahead of you. That's the facts. And when you are coming to a market that is in a different language, different part of the world, with a whole series of new investors, that's a big challenge for you. And as I always explain to management teams, when you go out and you sell shares at $20 a share, there is an expectation that the investors that bought those shares at $20 a share, when the stock gets to 30, they're going to sell. Some of them are going to sell. And that just means that you have to reload with a brand new set of shareholders who are all going to be convinced that they should buy your shares at 30 because you're going to 50. And at 50, you got to do it again with those shareholders that think you're going to 70, and on and on and on. And so what we've really focused on at Nasdaq is to try to understand what those needs, goals, desires, and rationale are of those companies, and make sure that we can put a framework in place to support them as a public company in the United States. And that's one of the ways that we've really thought about, and we think been thoughtful about, growing our business, which is, listen, companies are listed with us. We can go and visit them 2, 3, 4 times a year, talk about what's going on in the US markets. But the reality is we built a service business of all of the products and services that a company needs as they make the transition from private to public, and then engaging with them every day as a public company. So it's all of those services that a company needs to be public. Because there's one thing about thinking about going public, and then there's the other, which is being public. And so what we really think about is what I like to call, where Nasdaq shines when the bell stops ringing. Because here in the US, we have our competitor and we have ourselves, and on CNBC or Fox or Bloomberg or any of the stations in the morning, side by side at 9:30 in the morning is our opening bell and their opening bell. Companies come and do an IPO. You could be on the left side of the screen or the right side of the screen. Really, at some level, it doesn't really matter. The reality is that the next day, you have a whole new set of challenges. And so the way that we have, and I think thoughtful exchanges around the world have engaged with customers, is to say, how can we provide value when that bell stops ringing and when you've got to engage with these new set of shareholders? And we walk them all the way through the process pre-IPO, but I think more importantly for us, it's what happens after that company goes public, so that when you're 10 years in as a publicly listed company on Nasdaq like Mercado Libre, you've really had ongoing engagement with your exchange where they're providing value service to you. And that's where I think that the exchanges over the past decade or so, especially as we've all become public, where we've all tried to differentiate ourselves. A listing is a listing is a listing. The SEC blesses a company, the company gets to list on an exchange, the company chooses which of those exchanges to be listed on. The reality is the value truly for that company comes in what the exchange is doing for you and how they can support you as a public company. And that's what we really focus on here at Nasdaq. And I think what companies should focus on, no matter what jurisdiction that they decide to list in.
Every company has the option to choose in which stock market to list its shares. what do you believe that sets Nasdaq apart? And how do you deal with foreigner issuers, especially Brazilian ones?
Well, I think we do something, I'll take the second part first. I think we do something that's very unique in the industry, which is we treat all of our companies exactly the same. Which I mean, we think about our companies, foreign private issuers or domestic issuers. We think that they deserve what Nasdaq can do to highlight them as a public company. So, for example, I'll stay on Mercado Libre. One of the great things that happened to them this year, 10 years in, is the fact that they joined the Nasdaq 100. So companies from around the world, and we have about 15% of our companies are foreign private issuers listed on Nasdaq. And so that would equate to about 500 companies are foreign private issuers listed with us. Any of those companies here in the US, they can't be part of any index. So they can't be part of the Dow Jones, they can't be part of the S&P 500, can't be part of most of the MSCI indices, except the local indexes that are traded here in the US. But the biggest index they can become part of is the Nasdaq 100. So we have 4 companies from China, we have Mercado Libre, and it's based upon a just absolute process of looking at the 100 largest non-financial companies listed on Nasdaq. That's it. If you meet the criteria, you're in. If you don't, you're not. So we don't think about things differently as some of the other exchanges do. We also think that companies choose where to list based upon a number of different criteria. I'd say we shine in the areas of great liquidity, superior brand, and that's why companies from around the world choose to come to Nasdaq, is because the companies that are listed with us are those that have defined the global economy over the past 25 years, and we think those joining us now will do that for the next 25 years. So when you think about the brand alignment, Nasdaq is growth and innovation and entrepreneurship, game-changing companies, and so that's where I think we have done well. And when companies are deciding to leave their local markets and come to another market, we think that there is a great gravitational pull to Nasdaq, and why we can, I think, do very well against our domestic competitor and do very well against any of the other global exchanges. That's in addition to branding and visibility and companies being put on our tower in the middle of Times Square and social media and all of the other attributes that come with being part of the Nasdaq family. And everything that we do, we wrap with some of the lowest listing fees in the industry. So usually that resonates with somebody, either the CFO or the IRO or whoever budget the fees come out of, that resonates with them that we've got very low listing fees. So we try really hard to make sure that we can provide great value each and every day.
Great. One last question.
Sure.
What do you believe are the difference between US and Brazil on the perception of investors? Do you see different valuations for some sectors, for example, for tech companies?
Yes, there are different valuations for technology companies here that are traded here in the US than are traded in the local markets. The reality is that investors can trade in any market around the globe, especially the largest investors. So we always refer to Fidelity. Everyone always says Fidelity and Capital and all the Vanguard, all the large institutional investors can trade in any market. But if you want to get the greatest group of investors, certainly in technology, life sciences, we've seen so many companies from around the globe actually leave their local markets and sometimes even delist. We had a Chinese company that left the London Stock Exchange last year to join Nasdaq, and they've actually tripled in value in a year, but they had been listed on the London Stock Exchange for 5 years without anyone really covering their stock. So it is being part of a family of companies. It is the company you keep, and it is the ability for investors to trade at not only the best price, but to trade in the greatest pool of liquidity seamlessly, cost effectively, and that's what happens here in the U.S., and that's why so many companies do choose to list in the U.S. markets, especially on Nasdaq, rather than the local markets.
Okay. I think that's for you and Francesca, because I think they have touched this in the first panel. Do you think we are missing any legal protection, that we should change any regulation in general for US and Brazilian markets?
I mean, there's some parts of the U.S. market or the U.S. regulations that maybe aren't the best, right? The development of the plaintiff's bar in the U.S., I think most people would say that that's not necessarily protecting U.S. investors on a day-to-day basis. I think it achieves a lot of other things. But I think that in Brazil, kind of one thing that would be good to see is, I think there are a lot of regulations that go to fair disclosure of information, focus on accounting standards, things like that. What there isn't as much of is sort of an understanding of the underlying of why that's important, right? Okay, so you'll get comments from the regulator about add disclosure on this, that, and the other to check boxes on a form, and that doesn't necessarily mean that that information is conveyed to the investor in a way that it understands the risks of investing. And I think one thing that the U.S. Regulatory system does do is that it focuses on communicating those risks to an investor in a plain English way that the investor can understand it. I do not think the Formulário de Referência does that. I'm not even sure, visually how you could focus on what is most important. And so I think that a lot of the regulatory framework is there, and it's extremely well-intentioned and important. But I think that what is needed is a little bit more of a focus on making sure that the public can digest and understand that information. So it's not like a regulatory change, but I guess it's more of an interpretative type change.
And I think very different than other exchanges and different regulatory regimes around the world. Nasdaq thinks that we have kind of a sacred charge that's really been bestowed upon us to be the voice of the issuer, to be the voice of our customers. And so we actually put forth a blueprint earlier this year called we call it internally Project Revitalize or just Revitalize. And it is about focusing on the ways that we should be looking at the U.S. markets to bring about change in a positive way for issuers and investors. And so some of the things we talk about certainly are tax reform, tort reform, simple things like extension of the confidentiality of an issuer's IPO to all issuers, not just those that met the criteria of $1 billion or less. So that actually was implemented shortly after the new chairman, Jay Clayton, took office. He embraced our idea and implemented it. So we think that there are a lot of areas. Another one we put forth was the idea that a company of smaller market cap and limited trading float could ask for all of their shares to be traded in one exchange, the exchange that they're listed on, rather than, as you may all know, here in the United States, we have 13 different registered exchanges where the trading is very fragmented. And to allow for an issuer to really understand what's happening in their trading by having all of their trading in their small cap stock trade on one exchange would be a huge benefit to both investors as well as to issuers. So we put that forth. So I think we want to just continue the discussion. So we're going to continue to put forth ideas that we think will benefit the market and most importantly benefit our customers.
Good. Thomas? As you are one of the most experienced executives leading private equity transactions on real estate, Would you share with us your view on the evolution of the public market and the IPOs of real estate companies spanning 15 years? And it would be also great if you could speak on the current demand and the importance of having scale and sponsorship to be successful and for companies to be attractive to funds.
Sure. Thanks very much, Vanessa. Good morning. As Vanessa mentioned, we've been involved actively in the public markets in Brazil since 2002. And my remarks will focus really on the real estate sector, but many of the comments I think are relevant to more sectors in Brazil and to LATAM generally. We began with our first offering, and just as a historical context, in 2005, there were, ours being the second public company in Brazil, Gafisa, combined with Cirela, had combined a market cap of about $2 billion. Fast forward 10 years, there are 30 listed companies in Brazil in the real estate sector broadly, market cap today of about $20 billion. That group of businesses, high water, with exchange and multiple growth was probably 45 billion. So it evolved into a relatively important sector. The other data point is in Brazil, there's a local public entity called the FII, Fundo de Investimento Imobiliário. 10 years ago, there were about 73 fees, combined value of about 800 million US. Today, there are 350 fees, market value of about 40 billion US. So the real estate market in Brazil, both for listings of public companies and fees, has grown and is a relevant asset class, to be sure, for local investors and international institutional investors. The rollout and kind of the boom of 05 to 08 in Brazil for public offerings for real estate companies, for many developers, was a dream come true. That capital had never been available. In most instances, you had family, private developers who literally never dreamt of having an opportunity to monetize their company, have the ability to, in some cases, sell important secondary components, take cash out, have dream a liquid product, a liquid security, and have eternal access to capital, which we know nothing's eternal. And certainly, as you mentioned, the windows, the equity markets in Brazil can be very short. The bankers did a very good job of presenting this opportunity to developers. They latched on, and there was a period of time when we kind of joked and said you could take a club sandwich public in Brazil, meaning you didn't need a business plan. You could have a bank actually lend you money to buy land that was all represented on future sales, have a limited track record, hire an IR person who had worked 3 months at a newly listed company, name them a CFO, and raise hundreds of millions of dollars, and then pay the underwriting fee to the banks, and probably pay them back for the land bank they lent you, and hope to God you're able to execute on a business plan and be stewards of capital that you were never even faintly aware of. That happened. And as a result, the good news was these companies had access to capital. The good news for them was that it allowed them, vis-a-vis the lending institutions who were just getting in the game, the local Itaús and Bradescos, to have institutional patina and potentially provide mortgages to the buyers of the homes that these folks were going to build in the future, or mortgages on buildings that these folks were going to build. But for the investors, it provided some transparency, albeit early stage, and we can talk about how it's evolved over time. And there was good, I think, movement in terms of how things evolved, certainly the past couple of years, some for good reasons, some for bad reasons, but the net is the increased transparency and scrutiny that companies are under, net is a positive for investors. But it also had the impact of raising, in the case of the home builders specifically, land prices, because traditionally the home building business in Brazil, the home builders didn't have access to capital, so they would go to a landowner and work out a permuta, which was a swap, where the landowner would give you a piece of land, quote unquote, give you, for an exchange of future sales. And so it was a deal that would get done. As the project got developed, the developer would pay off the landowner, everything would work out well. Well, the landowners got the smell of the cash and the billions of reais that were coming into the market, and so they said, we're not going to swap anymore, we're going to take hard cash. And so that began to happen, and as these businesses came into the market and had the pressure of showing use of proceeds and what they were going to do with the money, again, that they never dreamt of having before, they would go out and begin to buy land. And what happens? The price of land went up, especially in cities like Sao Paulo and Rio. That's fine, because you could underwrite it and you could show, well, the land prices have gone up, but oh, by the way, housing prices have gone up. And so we're going to, in our underwriting models, lay out that over time the home building prices are going to keep pace with the land prices and our margins are going to stay firm. Well, we knew that wasn't the case. The problem for the home builders is, and for investors, is that it takes 3 years to go all the way through a project. And so in 08, 09, when you had the majority of this capital coming in, and again, many times for the first time, these developers putting serious amounts of money out, we knew in 2 to 3 years, the results were going to show up, and they were not going to be what investors expected, it weren't going to be what analysts expected, and weren't going to be what the market expected. And sure enough, that happened. And it happened in probably 2011, 2012. And that was the period where we believe that that the capital markets and certainly the real estate sector kind of graduated from elementary school and moved into early stage high school. And we can kind of laugh about it, but that's how it's evolving. And you can look to Mexico today and say they were probably 5 years behind Brazil in terms of accessing public equity. The difference being in Mexico, it's mainly the afores, so it's local fibras and secades. But the same thing is going to happen, we believe, in the next year or two in Mexico, where the results are going to come back, investors are going to be disappointed, there's going to be a reshuffling of managers, and Mexico will follow Brazil and kind of get into colegio out of escuela. We're dreaming that, someday Brazil will get to undergrad and maybe on to grad school, but that's still ahead of us, and frankly presents really interesting opportunities for us. I think more broadly, besides investors, developers, founders, realizing that the ringing of the bell, and to take both of your comments about the issuer wanting to write a book, I would argue that there should be a sequel or a trilogy, because the first interesting book is up until the ringing of the bell. But we would say the work really begins after the bell starts and is rung, and moving forward, and getting through the first analyst calls, and getting through the first year of results, and getting through meeting expectations and hopefully exceeding expectations, and frankly managing expectations, and folks and personalities that were genuinely optimistic and had the Brazilian view of we're going to get through it and everything's going to be better, coming down to reality and saying, you know what, as I mentioned to one of the home builders who came to me 6 months after he had rung the bill in Brazil, and he said, Tomas, I can't stand it. All these people are calling me, these analysts. They're asking these questions about my company. And I said, hey, dude, it's not your company. You sold your company. It's their company. And if the bankers didn't tell you that, shame on them. But you have a fiduciary responsibility to openly communicate what's going on with these companies, and it's no longer your business, and it's no longer your view on who should be asking you what. And that's still the case in Mexico and in Brazil. But I think that along with this transparency has come the importance of corporate governance, and I think Novo Mercado helped advancing scrutiny, and again, raising the bar is helping. I would tell you there's still a long way to go, both in Brazil and more broadly in LATAM. I think that the influx of international investors helps. The problem is that after 07, since the end of 07, there hasn't been a, green light market for public offerings for more than a quarter or two until now. At least the data we look at from BTG, who's got pretty good data on kind of the market trends that have to be in place for the window to quote unquote open. They haven't been there. They're coming back, and as you heard earlier, and we can talk about now, the trends are back, and it looks very good for the next quarters. But up until now, generally speaking, and specifically real estate, there's been nothing happening for the past couple of years. So that means that 30 public companies that listed from 05 to 08 have now come back to 25 or 26, and of the 25 or 26, 5 probably shouldn't be public, and those are going to either die on the vines or be gobbled up through M&A and merge, which is, again, the next evolution of the capital market, and frankly, something that we think is exciting and interesting, kind of about consolidation 2.0, consolidation 1.0, especially on the shopping center sector, took place with BR Malls kind of leading the charge and having a sector that traditionally was developers, that if you look at Multiplan, Iguatemi, those were developers of shopping centers that would keep a slug of their development proceeds as ownership and then manage these malls. And that's how it happened here in the States. If you look back 30 or 40 years, the developers and large shopping center owner operators here were the same developers. Over time, they migrated to consolidating a very fragmented industry. That first round of consolidation took place really with BR buying up assets and portfolios. We think that there's now a situation in Brazil where there's going to be consolidation 2.0, and that can play out in acquisitions of assets, certainly portfolios, and potentially for the first time, mergers of public companies. And so when we think about not only in the shopping center sector, but more broadly in Brazil, and if you look more broadly LATAM, which I'm sure everybody is to some degree or another, we see the next evolution of the capital markets to play into Brazilian public companies, which they've done certainly in other sectors, but from a real estate perspective, looking at merging and expanding outside of Brazil. We look at public companies in Mexico, where the other large percentage of the activity is in the region, to, again, down the road, potentially being able to invest in Brazil. For us, that offers opportunities. We're private equity investors. We're traditionally looking at private companies, but we've gotten involved in public companies as well when there is a similar activity that's needed, whether it be right-sizing the balance sheet, building out management teams, accessing better sources of equity, better positioning companies within markets. Those are the kinds of things we do both in public and private companies. And certainly there's a lot of work still to be done both in Brazil and beyond. If we look today at where these trends are, what's typically driven wide open windows for accessing the public market, it's really 3 things. It's flows of capital. And if you look at flows coming into Brazil today, international flows are up higher than they've been over the past 3 or 4 years. If you look at where the volatility is, both globally and then within LATAM, much lower than it's been, certainly for Brazil over the past couple of years. And then last but not least, where's the money going? With Selic coming down in Brazil, you've got money coming out of fixed income and coming into equities to the like that we haven't seen since 08, 09. And with that money leaving fixed income, driven mainly by Selic coming down, and also fueling equity price, and equity pricing is rich. And so when those 3 phenomenon kind of align, you're going to have windows that are open, which you're seeing in Brazil. Real estate is lagging. You've had a couple follow-ons, but you haven't any initial offerings of real estate companies in Brazil. We would think that there probably will be. There's space. Not probably on the home building side. That's saturated. Shopping center probably saturated. But when you look at other markets where there could be lending, specialty finance vehicles publicly listed, certainly in logistic warehouse space, there's space for that. There's international and local demand. So we are, I'd say, happy and continue to be intrigued and pleased with the evolution of the market in Brazil. We see certainly green shoots in the near term in terms of the market coming back. From an international investor perspective, local demand is huge in Brazil already, as you know, and yet we still see long runway for a lot of these businesses because at the end of the day, they're built and supported by fundamental demand. The access to capital is great, but at the end of the day, you've got to have a burgeoning middle class, buying homes, taking advantage of infrastructure, logistics distribution, and retail.
Thomas, sponsorship has been very common in Brazilian IPOs in the last years. Where do you see the sponsorship role fit in today's market? Do you believe it's institutional plus or a necessary evil?
I think that sponsorship continues to be important. for two reasons. One, I think that there's now evidence in Brazil, not only in real estate but other public companies that came into the market, had sponsorship. That sponsorship left, generally because they were capital profile capital, whether it be funds that had certain life cycles where they needed to exit. And some of these companies lost their way and lost their discipline that the sponsor in some ways was directly involved with or tangentially involved with. And so I think that now we've seen what can happen when kind of the parents or at least the young adults leave the room. I also think for new businesses that sponsorship adds a level of institutional credibility to the business, meaning the business plan. The plan has been proven. Management team is in place. Some level of institutionality has been put in place. Committees have been put together, not only been put together, but have been active and are properly staffed. ESG is a new component to the business. 10 years ago, ESG were 3 letters, it meant nothing. Now it's very important. And getting that institutional component included into, and not only window dressing, but actually having practical initiatives that companies can demonstrate. All of those elements, I think, still play a real role for institutional investors. And that's not to say if sponsorship isn't there, something can't get done, but it is to say that if there is sponsorship there, I believe that you may be able to either have a higher probability of an offering, probably have a lower either discount to what, or ideally a premium to where things can be listed, and also I think attract a better quality, stickier initial shareholder base, as opposed to flash cash funds that are in and out. You would have most likely a better medium and longer term hold investor as long as some of the fast money.
Great. One last question. And how do you compare M&A and an IPO as an exit for the private equity funds? Francesca, you may also comment.
Speaking for us, I won't speak for other funds, but speaking for us, when we make an investment, we never rely on a public offering as an exit. If the window is there, we've been doing this long enough where I don't think anybody can look out. You know, our investment horizon is 5 to 7 years. I don't think there's anybody, and if there is, please raise your hand and we'll talk about this afterwards, who can look out 5 years from now in emerging markets and tell me what public markets are going to be available for IPOs. We'd love to share and benefit from your insight. We have that as a potential exit. When we think about exiting, we focus more on building scalable businesses that'll be attractive to institutional capital, whether it be local pension funds, which now are big investors in Brazil and the Andean region in Mexico. That wasn't the case 10 or 15 years ago. Strategic operating businesses in the logistics space, in the retail space, or long-term institutional investors that are in country. Again, 10 or 15 years ago, you didn't have the Canadians, you didn't have GIC, you didn't have Temasek. They're in Brazil. They are long-term holders of real estate businesses and interested in institutional scalable platforms. And so from our perspective, the IPO market is there generally and certainly dependent on the windows, but we're much more pleased today at the other options that are available in Brazil because of this institutional commitment over the past 5 to 7 years, which we know will be there way beyond our investment period.
I mean, I think that the beauty of it is that you could have a dual process and see how they both play out and look at the valuation and decide which way to go. I think that in this market, you know, it really depends. It depends on what sector you're in and the risk appetite that a potential buyer wants, right? Like, I think some folks, especially in family-owned companies, and like they may want to continue to be involved in the business, and a lot of times a strategic investor is not necessarily looking for that. Sometimes they are, sometimes they aren't. The IPO gives them the ability to sell a much smaller portion and continue to be involved in that, right? And then decide over time what you're going to do with that. I think on the M&A side, the real challenges to executing M&A deals in Brazil remain valuation, because you're really still seeing a discount because of the different types of potential liability risk and the appetite of a buyer to stomach that risk. So a lot of the sovereign wealth funds may have a higher risk appetite, and especially depending on what jurisdiction they're in. And in that case, it can make a whole lot of sense. The tricky thing about Brazil, it's going back to maybe regulatory reform, but is that there are a bunch of things that you can be held strictly liable for when you're an owner of a Brazilian business. And we've seen that play out fairly recently with some PE funds. And so that can be a scary proposition if you're investing. And we don't have here in the US, the idea of piercing the corporate veil and making individuals responsible for those types of risks. And in certain types of risks in Brazil, you could be individually responsible. So I think it's really a risk appetite and then a valuation exercise, I think.
Okay, I've got a sign that we're out of time. So I want to thank Francesca, Robert, and Thomas. Thank you all for coming.